Hello, and welcome back to Financial Education. My name, as always, is Zach Collins, and today I'll be talking about the ways the rich make their millions. That's through something called negative gearing. I'm sure this is something that everyone watching this has heard of, and something a lot of people put negative connotations on. However, as I'm hoping to show you today, it's something anyone can do, and it's something you need to keep in consideration, when you build your investment portfolio on your wealth building journey. Before we get into that, for those that don't know me, what is my background? I was a financial advisor in my past, fully licensed, fully FISA compliant, specializing in super and non-super investments. I'm not licensed anymore, but I'd love to get my license back one day. I chose to leave the industry as I couldn't stand the owner of the business, and its firm was very heavy sales. I have no interest in sales. It's not all sales, but my passion is to help people not to sell various managed funds or insurance products. These days, I work in tax and compliance. Now, every tax system is different, and wherever you live in the world, it's important that you know and understand the intricacies of your specific tax jurisdiction, because there are a lot of ways that you can save money on tax that are 100% legal and legit. You just need to know about it and make use of it. Negative gearing is just one of those. Firstly, if you've never heard of negative gearing, what is it? The basics of negative gearing is that you purchase some sort of investment, usually using debt. The operating cost of owning this investment outweighs the income it generates, and thus you end up losing money each year. This could be a small amount or a large amount. It depends on what you invest in and how. With this loss, use it to offset any other income you have. Normally we're talking salary income, but it could be other investment or rental income. This results in a reduction in the amount of overall tax that you have to pay. This might sound like you're taking advantage of the tax system, but it's just using basic tax rules that everyone can use, and it's basically multiplying it as much as you can. You can negative gear any type of investment. I'll mostly be focusing on property today because that's how most people do it, but do take note that it can be done with any type of investment. The exact same principles apply. Do bear in mind that when I say any investment, in order to negative gear, you need to buy something that generates an income or is likely to generate income. For example, you can't negative gear Bitcoin. Why? Because Bitcoin doesn't generate a yield. This is key. If you bought Bitcoin with debt, those interest expenses could be allocated to the cost base and it will reduce the CGT when you sell. But you can't claim the expenses every year. Buying a tech stock, however, well, it might make a small income, let's say 0.5% or even less. The fact that it does produce some sort of income, that's enough to satisfy that requirement. I think I've said this in previous videos, but everyone is allowed to claim deductions for expenses that they're incurred in the process of producing income. It's part of the foundation of our tax system. This is the key point. You can only claim deductions for expenses if you're trying to generate income. If you buy land and your land bank plan to sell that land in 10 years' time, hoping for some capital appreciation, you can't claim the ongoing expenses for the land investment on your annual tax return. Because, as I said earlier with Bitcoin, land doesn't generate a yield. Any costs you do incur would be added to the cost base of the asset, and this reduces CGT. But it's not something you can deduct in the short term and offset your other income sources. If you took that same piece of land and used it for farming, or it had a house on it which you rented out, and this is done in the pursuit of earning an income. This means you can deduct any expenses you incur on this investment from the income that it generates. One thing that is particular for property, both residential and commercial, is that you're allowed to also claim depreciation. Depending on the type of property and what's inside, there's potentially a mix of Division 40 and Division 40 depreciation you can claim. If you bought shares, let's say CBA for example, shares don't depreciate. They may have some offices that they own and they would depreciate those offices. Now, this affects CBA's balance sheet, but it's not something that you can claim yourself. Property is the one difference, and this is one of the key things that investors look for when they purchase some properties, because depreciation reduces your tax in the short term, but it's not actually a cost that you physically have to spend. It's all a paper loss. At the end of the financial year, you add up all your allowable deductible expenses for an investment property. This could be agent fees for leasing out the property. You're talking land tax, water rates, insurances like building insurance, landlord insurance, interest expenses for loan. As I said earlier, depreciation that falls on Division 40 and Division 43. Regardless of whether you're generating a lot of income or only a small amount of income from this investment, the full amount of deductible expenses can be used to offset your other income sources. When you do earn income from this investment, you need to make sure that the income generated is done at commercial arm's length rate. Let's consider that this investment is a residential property. For whatever reason, you decide to rent it out to a cousin at a very low rate. Let's say the market rent is $500 a week, but you do it at a friends and family rate of $200 a week. If you do that, then you can't negative gear the investment. If you don't charge market rent, you can only get a deduction such that the income is offset by the expenses. In this case, given income is $200 a week, the maximum you can claim in allowable deductible expenses is $10,400 a year, which is $200 times 52 weeks. If the expenses are less, you can claim all of them. However, if the expenses are higher, that $10,400 is the most you can claim, as the arrangement is not arm's length. If you rent it to your cousin and you charge them the market rate of $500 a week, all of the allowable deductible expenses can now be claimed. The fact that you're renting to family is irrelevant. Given that it's market rent, you can claim market rent expenses without any penalties for the arrangement. Now let's look at how these investments generate their income. The majority of investments produce income of some sort for the investor. Property generates in the form of rental income, shares in the forms of dividends, and bonds and savings accounts in the form of interest income. As I mentioned briefly, if you want to negative gear an investment, you need to be firstly earning some sort of income. This means that stuff like land banking or high-tech growth stocks that don't pay dividends or crypto would not be able to be negatively geared. You can still get a deduction in the future as the expenses incurred on the investment get added to the cost base, and it reduces CGT when you eventually sell. The second part is that it needs to be income earned at market rates. As I said, if you rent it to a cousin, if you charge them less than market rate, you need to zero out the income and deductions. Now, many US companies pay a really low dividend. Now, unless you've got hundreds of billions, even trillions of dollars. Now, Apple, for example, is around a $3.5, $4 trillion mark. Unless you're one of the richest people in the world, you're not going to be the one controlling the company. This means you have no control over how much or how little they pay out in dividends each year. Given that, you can fully negative gear that low income investment because it is still paying out income at market rate. Negative gearing gives a connotation that you're getting a negative return, and that is true. In the short term, you are. Longer term, it can really depend. The next step in the process is that you take your income, whatever amount that is, you take away all the allowable deductions. If you have a positive number resulting from that, you are positively geared, and you pay income tax on that amount as it gets added to your other taxable income. The amount you'll pay will be based on your marginal tax rate. Let's say your day job is $50,000. You have a positively geared investment making you $5,000 a year. You'll get taxes throughout your financial year. You earn 55 grand. The opposite happens when you have a negative number, and that is what's called negative gearing. If your income less deductions from the investment is negative 5 grand, using that same $50,000 of income before, you can use this $5,000 loss from your investment to offset the income earned from your day job. This means you'll be taxed as though you only earned $45,000 that financial year. Essentially, that $5,000 loss acts as an extra deductible on your personal income, and you'll get that tax refunded. The issue with this is that by holding this investment, it's costing you money to hold. The capital growth of the investment doesn't necessarily change whether you're making a profit or a loss. You just now have extra costs to keep that investment. Because the loss is deductible against your other income, you get that tax paid on that amount back. While you do get the tax back, this means that the lower your taxable income, the worse the return you're getting is. If you're earning under $45,000, you're getting a maximum of 16% of that net loss back in tax return. On $5,000, this would be a maximum of $800. So it means it's still costing you $4,200 each year just to hold this investment. So not only are you not making money, you're losing it just by holding the asset. This is where opportunity cost comes in. You need to consider whether it is worth it holding this particular asset, or if it's costing you money each year to hold. Why aren't you investing it elsewhere? Getting potentially the exact same capital growth but having a positive income return. Even if you are neutrally geared, that's where income and expenses offset each other to nil. Assuming the same capital return, you're $4,000, $200 better off investing elsewhere as you're now no longer losing money each year. The more you earn from your day job means the higher your tax bracket is. And this means that the more tax you get back from a negative gearing deduction. With that same $5,000 loss, someone in the top tax bracket, that is income over 190 grand, would get back 47% of that $5,000 because that is their marginal tax rate. This equates to a $2,350 tax return. It is still costing them $2,650 to hold this asset, but this is $1,550 less than it's costing someone in the lowest tax bracket. Not only does it mean they get a higher return from a lower income earner with the same investment, but someone earning more income from the day job would have more disposable income to be able to afford to lose money in the short term for the hope of longer term returns compared to someone living month to month. So what are these long-term returns people that negative gear try to achieve? That would be higher capital gains. Now, this strategy is not foolproof. It's not perfect and it doesn't work for everything. But as a general rule, the returns for all assets tend to be roughly the same. If we assume that all assets earn the same overall return, the difference then becomes the split. How much of that return is income? How much of that return is capital? If you assume that the total return is, say, 5%, could be 0% income and 5% capital growth, or could be all income and no growth, or could be 2.5 and 2.5, etc., etc. You guys get the point. Most people that go for a negative gearing strategy, they aim for something that has a low income return, still market rate. This allows you to get the full deduction, but it has a really high proportion of the total return as capital growth. They use the large deduction to offset the tax in the accumulation stage, as I showed before, and this works best for those in the highest tax bracket. And then they start selling down once they've retired and they don't have any other income. When you sell assets held for over 12 months, get a 50% capital gains discount. So when these people have retired, they no longer have their day job income, but they're still entitled to the tax-free threshold, which is currently about $18,200. With both the discount and as part of a couple, you could sell around $80,000 in long-term capital gains each year without ever need to actually pay any tax. When you do purchase an investment, you want to ensure that whether or not you end up losing money in the short or long term, that this is an asset that you want to hold long term. There is no guarantee of high capital gains, and depending on the asset you pick, there could be massive opportunity costs buying something only because you know it will generate a capital loss in the short term, and you'll pay less tax. As I showed in some earlier calcs, you still lose money with negative gearing. The tax break doesn't pay for everything. I love the saying, the market is able to stay irrational longer than you can stay solvent. In theory, using a negative gearing strategy might really help build wealth and be a good tax minimization strategy. However, you really need to be mindful that the strategy is really best suited for those on really high incomes that have significant discretionary funds. If you ever need to sell in the short or mid-term, the negative gearing might end up being more costly than buying without the leverage or buying an investment that would generate a positive return year on year instead of a loss. It all comes down to what asset is and making sure that you pick the right one for you and your situation. Now, all investing does have risks, and you need to make sure you understand the consequences of whatever investing strategy you decide to follow. Hopefully, I have been able to help you better understand how negative gearing works, the pros, the cons, the benefits, and the pitfalls. If you've got any more questions, please feel free to drop a comment below and I'll answer if I can. Thank you guys so much for watching, and I'll see you on the next one.